So I talked about principal pay down. So if you've ever seen a graph like this, you know what I'm talking about. If you haven't, I'm about to blow your mind. What you're looking at here is in basically a graphical version of what's called an amortization schedule. So when you get a loan from the bank, let's say in this example it's $300,000. Have you ever wondered why your mortgage payment doesn't go down over time? Because wouldn't it be true that like if your interest rate's 5% on 300,000, what would that be like the first year? That would be like $15,000 in interest the first year. And then like what would it be the second year? Well, actually, if you didn't pay any principal, it would be the same amount. So how do they figure out like if you've ever really thought about it, you're like, what how is the payment amount the same for the whole time that I have the 30-year mortgage when the amount that I owe is going down? Isn't that like kind of insane? Well, the way that they do this is they calculate the total amount of interest that you're going to owe over the lifetime of the loan, and then they spread it out to make the payments equal. It's kind of a really weird thing, actually. And so what you're looking at here is how those interest payments are distributed. And if you've dealt with banks, there's maybe no surprise that they loaded it the way that they did. They front load all the interest, right? So the interest is completely front loaded. There's no reason it couldn't be the other way around. Like picture the inverse of this graph. There's no reason it couldn't be that way, but no, they do it this way. So you pay all the interest up front. So in that first 5 years, 7 years, most of your payment is going to interest. And I think a lot of people have heard about this and that's something they've heard people say before, but there's something about seeing it graphically and seeing what happens near the end that really changes the game. And so when I say that things compound on the previous slide, you can start to see why. After you're 15 years in to a 30-year mortgage, in that second half, especially like the last like 1/3, your payment is like mostly just going to principal. So you're kind of like, it's almost like you don't even have a mortgage anymore. You're just taking some money from one pocket and putting it in the other pocket because it's almost all principal. So if you constantly transact and trade in and out of properties or refinance like every 5 years or less, you never get to the good part. You never get to this nice part where you're actually paying down your principal really, really rapidly and getting more and more equity in the property. So I don't know. I think this is a really interesting graphical way to display some of these things I'm talking about where like you got to stay in it for a while.